Hey friends, we're gonna talk about debt to income ratio today. So don't let that term scare you away. It is one of the most important factors that we look at when we're trying to qualify you for a home loan. So basically how this is calculated is that if you take your gross income, so that's the amount that you make at work before any taxes are taken out, any 401k contributions, just like the big number. So if you take that, that's your gross income. And so then we compare that to your debts that show up on your credit report. So if you divide your debts by your gross income, that gives your debt to income ratio. And the whole point of it is to make sure that you make enough money to pay back this loan over a long period of time. So in this debt to income ratio, there's two parts of it. One's called the front end ratio, which just looks at your new housing costs compared to your income. But the one we really spend most of our time looking at is the back end ratio, which includes the housing costs plus your credit payments, such as like credit cards, car loans, any of that stuff that shows up on a credit report, all together, and we compare that to your gross income. So there's no ideal ratio, but the great target would be somewhere between 40 to 43%. It's really important to note that certain loan types, like VA loans, which are from the Veterans Administration, and even FHA loans, which are Federal Housing Administration loans, tend to be more lenient. And so sometimes we can get approvals over 50% for those loans, and other loans are capped at 50%, but a lot of it depends on your personal situation, like your reserves and how much money you're putting down. So basically, debt to income ratio is one of those things we want to keep our eyes on. It's important to get your home.